Kia ora koutou, I'm Paul Conway, Chief Economist and member of the Monetary Policy Committee here at the Reserve Bank of New Zealand, Te Pūtea Mātua. Today, I'd like to walk through some of the key economic factors that the committee looked at when we decided to lower the official cash rate by 50 basis points to 3.75%. So let's start with inflation. The good news is that we've got headline or overall inflation back down to 2.2% currently, and it is expected to stay within our 1 to 3% target band over the next few years, which is great. As you all know, inflation has been well above target over the past few years, and it's excellent to be able to say that it's within target and expected to stay there. So let's break that down a little. We'll start with what we call tradables inflation. So this is inflation in goods and services that are exposed to international competition. So it's prices that are more or less set in global markets, prices that monetary policy in New Zealand obviously cannot influence. So tradables inflation coming over the border, has actually been negative recently. So we've been seeing deflation in this part of the CPI basket. And that's been really helpful in keeping overall inflation near that 2% mark, because domestic inflation, so this is inflation generated right here in New Zealand, is still too high. It's coming down, but it's still above where we need it to be to keep overall inflation near our target midpoint over the medium term. So why has domestic inflation been falling? The short answer is because interest rates have been at restrictive levels, and that has created what we call spare capacity in the economy. So demand in the New Zealand economy is currently below the productive capacity, the productive capabilities of our economy. So that has created an economic environment in which it's more difficult for businesses to increase prices or for workers to overreach with pay demands in excess of productivity growth. And all of that is helping bring down domestic inflation, and we expect that to continue. And we actually need it to, because we think tradables inflation generated overseas, is likely to bounce off its lows and increase this year. So petrol prices, for example, are likely to go up, and a weaker New Zealand dollar, just depreciated a bit, that will push up the cost of imported goods. Now, on net, we see a small inflation blip later this year, but we don't think that's going to get embedded into price and wage setting behaviour, because businesses expect inflation to be around 2% in the medium term. So inflation expectations are well anchored to the midpoint of our target, and that really helps to keep inflation under control beyond the short-run blips up or down. Now, with inflation stabilising and interest rates coming down, we think economic activity will recover over 2025. So lower interest rates will encourage households to spend more and businesses to invest, although we do think that uncertainty about global trade policy will likely weigh on business investment decisions to some extent. Also, a lower exchange rate and higher global prices for New Zealand dairy and beef also supporting New Zealand firms that export overseas. So strong export earnings are also likely to help lift growth over the next year or so. Now, in the labour market, we expect employment growth to pick up and unemployment to start falling later this year as businesses respond to improving economic conditions. Now, turning to the global economy, obviously geoeconomic uncertainty has clearly increased. Everybody's talking about tariffs, and all that is likely to weaken global growth. Of course, we're keeping a very close eye on that to assess how it's going to play out and impact growth and inflation in New Zealand. So, to sum up, inflation is in our target range and expected to stay there. Domestic inflation is still too high, but is falling. Economic growth is returning in 2025. Unemployment is around its peak and should start falling in the second half of this year, and global trade policy is a major watch point. Now, in response to all of that, we lowered the OCR by 50 basis points to 3.75%, and we hinted that it could go a bit lower still if the economy continues to unfold as we expect. Very important to note that conditionality in there. Thank you for listening. You can check out the full statement on the RBNZ website. Ka kite.